Hello everyone. This is the third lecture in the series of financial statement analysis. Until now, I have given you a brief introduction about balance sheet and income statements. And in the previous lecture, I also talked about the linkages between the balance sheet, income statement and the cash flow. Today, we'll take a deep dive into cash flow statements. Usually, when I have a discussion with people who invest in securities markets, especially directly in shares, then I find them mostly talking about the profit and loss account and the balance sheet. I have hardly known of many people who reach the cash flow statement in making the decision of investing or not investing. Well, it is very unfortunate that in most analysis and in most reports, first comes the balance sheet, then the profit and loss account, and on the fourth or fifth page somewhere you'll go and find the cash flow statement. Most people do not make an effort to flip those many pages. However, if it were for me, I would say that cash flow statement is the most important report that should be reviewed before you make an investment decision. And ideally, cash flow statement should be the first statement on the financial statement reports, followed by the balance sheet and profit and loss account. And soon you will see why. In our last discussion, I showed you how the cash flow statement contains any cash inflows and outflows. And not just that, it also shows you what that particular cash flow pertains to. So, a cash flow statement is divided into three categories: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Cash flow from financing activity is what finances a business. From where does the business get its financing? Is it from the issue of shares? Is it from the issue of debentures? Is it from a bank's borrowing? And how the business is repaying its debt, whether it is through the repayment of bonds or through the repayment of loans or through buyback of shares. So a lot of companies also use their resources to buy back shares from the market, because then it increases the value of the shareholders who are left invested in the company. Financing cash flows can both be outflow and an inflow. When we talk about financing inflows, it means that the company is raising debt or the company is issuing more shares. When we talk about outflow from financing activities, it means that either the company is repaying its debt or it may also be paying interest on that debt. Let's move to investing activities. When a company decides to purchase long-term assets in order to either expand its business or to get new improved machineries in the business, that would be considered an investing outflow. There can also be investing inflows, and that would happen when you dispose of a long-term asset. So in case a company decides to change its machinery altogether and it sells off certain machinery, then the cash received from that sale will be an inflow from investing activity. And finally, let's come to the most important cash flow, which is operating cash flow. Operating cash flow is the core of the business. That is the trading that the business does. How much cash is it able to generate from its core operations? A business which is very profitable, it keeps giving profits, higher EPS year on year, but is not able to generate operating cash flow, is not a sustainable business, because it would mean that the business is sustaining itself either by raising new funds or by selling its property and its assets. A company, in order to be sustainable, for a business to be sustainable, it must generate positive operating cash flows. Operating cash flows will be positive if the revenues collected from sales are higher than the cash which is paid out in order to run the business. So let's see what a statement of cash flow looks like. This is what the statement of cash flow looks like, and literally it is divided into three components. cash flow from operating activities or cash flow from operations, cash flows from investing activities, and finally cash flows from financing activities. As you can see, the major portion of operating cash flow consists of cash receipts from operations or cash collected from its customers. And cash outflow from operations consists of any disbursements made for purchasing inventory, any disbursements for meeting the expenses, wages, salaries, any interest related payments, and the payment of income tax. In the case of the company that we are discussing, as you can see, there is a positive cash inflow of 147,900. And this is a good sign because the company is able to collect more cash than what it is required to spend to run its operations. Let's look at the next category, which is investing activities. Here it says that the company has sold certain property and equipment, because of which it has collected 33,600 in cash, and it has also purchased some new equipment for which it has spent 75,000. So this looks like it is most probably the change of equipment. So it is possible that the company's existing equipment may be getting old and outdated, so it changed it for a new equipment. Finally, let's have a look at the financing activities. The company doesn't appear to have raised any new debt or issued any further stock. So it is not raising capital from the market. Rather, it is making payments for dividends and for repayment of debt, which is a good sign. And finally, if you would see, though the net cash position is not given here, the net cash position appears to be positive because this totals to 87,000 and the entire outflow of 41,400 and 87,000 is less than the inflow of 147,900. So you can see that the cash position of the company is positive and it comes to 19,500. Now the final cash position is not really important. What is important is whether the operating cash flows are positive and have a trend of increasing over time. It is a major red flag if you see that a company has increasing and positive net profit over a long term. However, its operating cash flow is negative. If you investigate further into the cash flow statement, you may find that the company has either been raising new debt or it has been selling off its assets in order to fund its operations, which is definitely not a good sign. It is not sustainable in the long run. So I usually try and steer clear of any stock of a company which has negative operating cash flows, because if a company is running a business, the least it is expected to do is to be able to generate enough cash in order to fund its operations. If it is not able to do that, that means this company is not a good investment to make. You will understand this more in the next section, which is financial statement analysis. I hope by now you have a decent understanding of what balance sheet, income statement, and cash flow statement comprise of. So when we move on in the next section to financial statement analysis, you will be able to appreciate what I am talking much better. So that is all for today. Thank you very much. I hope to see you in the next lecture.